today we are not called any chief guest, because I said when Madhvi like personality is there, she can play both the roles. And we are honored by her presence. Her assignments done during her career in Deloitte and Baker Tilly. Of course, here she is in personal capacity. So she is, I think you are with PwC, right? Madhviji? But she had
I was in PwC. Now I am a partner for valuations in Baker Tilly, India.
Yeah. So now, so she has both the experiences going on, and I'm sure we will learn a lot. A little about Association of Valuation Profession. It is a national society registered under Societies Act, and we have members joined us from not only India, all the states and the union territories, but also even to the smaller cities like Akola, Amravati, Thrissur, Hisar. I mean, some of the names even I didn't know actually. We have people from Guwahati, Surti, Somnath, Rajkot. So the valuers of all types are there. One need not be a registered valuer for the purpose of becoming a member. One can be only interested in valuation and he can be a member. We have many CFOs also. We have Deloitte valuation head Sanjeev Sawal sir as a member. Then we have past presidents of ICMA as members, some of the CCMs and RCMs of ICI as members. And we have members from London, Australia, and Dubai actually. And recently we had a tie-up done with one of the ASA, the American Society of Valuers. The international tie-up we have done. We already have a tie-up with IIV, and we have a tie-up with SME Chamber of Commerce. So we are knowledge partners to many. And the interesting part of this is that we learn everything online. We have online newsletter, we have online programs. Very rarely any physical program we hold. We are only 1.5 year old, but our fees are 5,000 one time lifetime. So we won't bother you every year, and all the webinars are free for our members. Initially, we have kept them free for others also, in order to join and make it a big model. So there are 51 participants already joined, and the number should cross 100. The capacity is 100 only, but around 250 people are in that group, I think, who have showed the interest. So they might join any moment, and the capacity will become full. But to all the members, before all of them join, to the audience, I request them to become the member of Association of Professional Valuers. In the chat box, I'm keeping my number to contact me anytime for becoming a member. The procedure is very simple. You can transfer rupees 5,000 to the account of the AVP Association of Valuation Professionals and fill up a simple form giving your name, address, email ID, and a copy of Aadhaar card and your photo. So that's as simple as that.
I will post the form on the group which we have formed for this program.
I think that will be great. And if you can
so
put
that
here
audience
in the chat
can download
box,
it anytime. Yeah, I'll put it in the chat box also.
So that on the spot, if somebody wants to take membership.
Yeah.
In fact, in the last some of the programs, some people took the membership during the lecture itself. So I would very much welcome, and I can see here a lot of senior people have also joined this lecture. So that shows that highly experienced people. Oh God, I can see Akshay Sane, and then quite a few people who are. Oh, Hingwani sir is there, Sangeeta is there. So Dahishilan sir is there. So some of I think the people are ranging almost of my 65, and some people are even senior to me. Kaji sir is there. I think they're quite senior people there. Shirley is there. Oh God. So Madhviji, I think there is going to be a very interesting discussion. Nitin, with this small discussion, I hand over to you.
Yeah, thank you, Bhavi sir. And again, welcome to all the participants. Before I go to introduce Ms. Madhavi, I would like to have some brief knowledge on our association. Mr. Bhave has already mentioned a lot about our Association of Valuation Professionals, but it's my privilege to give you some brief on our partners also. So there is a PPT, small PPT, which I can share here. Is it visible?
Yes.
Yeah. So Bhavesh sir, meanwhile, I am having this PPT. There are few new admissions. So
I will take
kindly
care.
admit.
I'll take
Yeah,
care.
thank you. Thank
You
you.
can
Thank
put it in the presentation mode if possible.
My PPT is not visible.
It is visible. You can put in a presentation mode.
Yeah,
Full
I'm
mode.
putting it in the full
All right.
presentation.
All right. All right.
Yeah. Yes. So as you all know, Mr. Bhave is the president of this Association of Valuation Professionals, which is just two years old. So there are three partners for this. One is, or associations rather. We are AVP, IIV, RVF is the another associate, and then SME Chambers of India. And recently, the organization from USA, where we have a tie-up, is not for me part of this PPT, which we'll update soon. So Mr. Bhave has already mentioned about the AVP as such and how to become members by paying only 5,000 rupees. And then you need not be a valuer or registered valuer for this. The milestones which you have achieved in last 12 months is the tie-ups with these organizations. Then we have reached a figure of more than 175 members. And we have published 20 e-newsletters so far. And on the Independence Day also we came up with, that was last year, not last year. Then we have held about 66, 70 webinars. And there is a big list of webinars which are going to be held in the next 2 years. So our RV Sandeep Agrawal, who is our vice president, he has acted in a great manner. And he has done everything to make the webinars possible, and also to generate more and more webinars, call upon the speakers to hold the webinars. So thanks to Sandeep. And this is a brief about the IIV. IIV is a registered valuer organization known as RVO. And Ilyas Amin Sheikh is the managing director of this organization. And they promote the profession of valuers in a big way. And they have contributed a lot. In the past also, they have conducted many webinars on the valuation subject, either offline or online. After the incidence of COVID, mostly it has been online. But before that also, they are holding it offline. I had attended their big webinar or seminar at Goa for 3 days with big eminent speakers presenting their presentations in that webinar, seminar. The webinar word doesn't go out of my mouth. And we have an association with them that also benefits us or our members to get the CEP hours, those are required. So because we have a tie-up, we can get CEP hours by payment of a nominal amount, which Aishwarya from IIV RVF can be conducted for more details. Contacted, sir, sorry. And SME Chamber of Commerce India is the organization which is working for the development of SMEs and in the manufacturing sector and allied industrial business sectors. Last 28 years they have been in operation, and they are supporting entrepreneurs like young and women entrepreneurs, startups, etc. And they are converting new concepts into profitable business ventures. They are channelizing finance from banks, FIs, export finance. So all sorts of help they are giving to the new entrepreneurs, the startup, etc. So we are very proud to have an association with them. Then why you have to join AVP as a life member? As Mr. Bhave has already explained, we are holding webinars every week. We have a webinar and we have e-newsletters. You can participate, the members can participate, even the non-members also sometimes participate in our e-newsletter. They give articles which we publish for the benefit of the valuer fraternity. You have a chance to be a speaker at our webinars, like today Madhavi is there. So tomorrow it could be you also. Share your knowledge with the others, and you can also gain from the experience. And when you pay a nominal fee to IIB RBF, you can gain those CEP hours which are required as per the IBBI. So there is a list starting from 11 February to the next March 23. We have a list of webinars which we are going to hold. It's already there, and we have fixed up some speakers. Somewhere the speakers are not there, which we are going to definitely do in future. And Mr. Sandeep Agrawal is always on his toes to get this done. So with this brief background, I would turn myself now to introduce. I'm doing a lot of things today. I'm doing some introduction also to Madhavi now. So I'll close the sharing. Sorry,
Madhviji, you are the co-host, so you can start sharing once Nitin is closing.
Yeah, let me be through with
Yes,
my
thank you.
introduction of Madhavi.
Oh, yeah, sorry.
Okay. So as Madhavi has already said that she is a partner in charge of valuations at Baker Tilly India. And before that, she was with Price Waterhouse. And she has a rich experience of 24 years on valuation. She has done many valuations like business valuations, intangible assets valuations, financial reporting purpose, then purchase price allocation, tax and regulatory valuations regarding the disputes and arbitrations. So a lot of experience or a lot of valuation experience is there with her. And she has also been associated with many institutes like ICAI and ICMAI as a speaker on this subject at various training programs and workshops. So we are very happy. This is a very, very brief introduction because she has sent me only this much. So very, very brief introduction I have given to you. And now I will hand over the mic to Madhavi for her presentation. Thank you very much.
Thank you, Nitinji, for that kind introduction. Honestly, there was nothing more for me to say about myself. So that was the brief which I had sent you.
That shows your humbleness.
Yes.
No, really,
We
it
know
all
that.
comes down. It just comes down to someone studying and then, working. So that's what it is.
No, we are actually waiting for you to deliver your subject lecture so that we get a lot of benefit out of that.
I really thank all the participants who have joined this webinar today. And I hope I can actually literally render value to all of you. Please feel free to stop me if you think I'm going too fast, or if you think that you want me to discuss anything in specific. Today's topic of discussion is the discounted cash flow method. And we will be focusing specifically on the DCF. If you need me to cover other topics, let's just park it.
Can I interrupt for a moment?
Yes, of course.
We'll have the question and answer at the end of your session.
All right.
So that it will not be too much for you to answer in between or get disturbed in between.
Okay.
So I'll request the participants to jot down their points so that at the end of this session, we'll have some 10 minutes for questions and answers. Okay.
Sure.
Thank you.
Okay. Let me start this entire discussion first with speaking of an overview of our valuation profession. What I'm not really aware of the level of experience and the level of proficiency or experience that people have with the discounted cash flow approach. So I have tried to go about it in a step-by-step fashion, starting first with what valuation is, then speaking of the approaches, and then diving into the DCF. But I think the first and most important aspect in the life of a valuer is to understand that we are undertaking a real responsibility and there is a real risk whenever any of us are signing a valuation report. I think apart from an audit report, the only other professional report that requires a signature before it is accepted by most people is a valuation report. That not only directly pinpoints you as the person who's responsible for that opinion, it also opens you up to risk. And that risk could be a professional risk, it could be your reputation, or it could even have other implications. It's extremely important for every valuer to be just like an auditor, independent in both appearance and reality. And it is just as important for us, like an auditor, to also maintain independence, objectivity, and to make sure that we do enough diligence that we are able to support our conclusions. So I've just jotted a few points. This entire presentation I made based on the thoughts I had in my head. So there are all types of valuations that we do. There is a business valuation, there are valuations for financial reporting, which could be impairment testing or could be purchase price allocations. There is, of course, valuation of intangible assets quite apart from a purchase price allocation. Sometimes we are called upon as expert witnesses or to do valuation in the context of arbitrations and dispute. And that is when we also step in and provide litigation support. In all these cases, the most important and valuable thing that we are offering to our clients is our opinion. And that opinion has to be a considered one. So not only is the need for expert valuation services increasing today, I think all of us have seen the kind of potential that this profession has now stepped into. Earlier, people were doing valuations because there's always been transactions. Recent changes have included, Ind AS coming into India with this extreme importance of fair valuation and presentation in financial statements. And then, of course, the regulations themselves have undergone a change. Now we have the concept of registered valuers. We still have all the old reasons for valuations as well, which could be tax valuations and RBI valuations under FEMA. So the need for valuation is only growing. And the context of any valuation in most cases, like I said, could be financial reporting, it could be tax, it could be an actual deal that's happening, it could be a legal dispute. Sometimes it could be a client simply wants to understand what value they have already created. So it could be just for their internal purposes as well. So whenever we are attempting to provide this kind of valuation advice, we have to use a combination of analysis, experience, and professional judgment. So in fact, I always think to myself, to be a good valuer, you need to be something like a jack of all trades. Whether you become master or otherwise, I leave it to each one of us. We have to understand valuation as a subject and the methodologies. We have to know accounting. We have to know tax. We have to be able to read and absorb, any kind of an agreement or, the implications of corporate law. So there are many, many things that we need to know about. We need to keep ourselves updated about, and there has to be a decent working knowledge, quite apart from just understanding what a DCF is or what a market multiple method is. At the end of the day, the deliverables that we give have to be defensible. They have to be well documented. Two types of documentation. One is the report that you set out necessarily should be complete. It should be able to tell a story and provide enough corroboration within its own contents to the reader. And there should be sufficient backup evidence as well that you have done a proper job in understanding your subject company, in understanding the facts and circumstances, and have done sufficient amount of validation before you have proceeded with your valuation conclusion. So extremely important. There is no one size fits all approach. The interesting thing about valuations is every single case will have some small quirk in it or the other. It's very difficult to say that you will simply take a template, populate it, and get a valuation out. So there's maybe 60% of any valuation could be automated. We are seeing plenty of very interesting products coming out in the market, but 30 to 40% still relies on judgment. And that is something that we need to be very careful about. This is just a snapshot of services, for our members who might, wish to see a complete list. So starting with business valuations, the most important one, of course, is when there is a deal happening, an M&A, there's negotiation support, because we are looking at actual price discovery in such situations. Then there will be share issuances, ESOP, sweat equity, which is required under the Companies Act. You will have acquisitions, mergers and acquisitions, swap ratio reports, which need to be, prepared under SEBI regulations, demergers, corporate restructurings. There could be a sale of a business maybe on a slump sale basis. Then, of course, a hot topic nowadays, which is startup valuations. Then you've got intangible asset valuations. Sometimes you will value intangibles because there is an actual commercial requirement. For example, you might be valuing your intangibles to present a number in your annual report, or you might be doing it because you want to go and raise funds based on the value of the intangible assets. Sometimes you will do it for financial reporting purposes, which would be a purchase price allocation in most cases. Sometimes you will even do it for transfer pricing purposes. So if, for example, if there is an IP in a company which originated in India, grew very large, decided to base itself out of India, maybe Singapore or the US, you will want to at some point, based on what their tax advisors are telling you, the company will say that now it wants to consolidate the ownership of the IP wherever the parent entity is residing, which could be, say, Singapore or US again. In such cases, the intangible asset will need to be valued and it will need to pass the test of transfer pricing. And it also, at some point, you may need to defend it to the tax authorities as well. So those are some of the considerations we will keep in mind when we are valuing intangible assets. Of course, there's valuation for financial reporting. As I mentioned, Ind AS now requires fair valuation of a lot of things on the balance sheet itself. It's become very close now to IFRS and to US GAAP. Some examples of those are purchase price allocations, impairment testing, financial instruments, and even portfolio valuations, which we do for private equity and venture capital funds. I've already touched on valuation for arbitrations and disputes. Some of it will be price discovery again, for example, a family settlement or an initial start of a shareholder dispute. Sometimes it will go right up to arbitration and to litigation as well. This is an overview of the key approaches in evaluation. You've got the income approach, which is what we are focusing on today. We've got the market approach and we have the asset approach. What I would like to emphasize over here is there might be three approaches. At the end of the day, the core of each approach is still a forward-looking approach. So it's not to say that when you're doing a market approach, you need to build projections, but keep in mind that every listed company that you will be considering in your peer set holds a certain share value because of the future earning expectations that the market has for that company. Similarly, in an asset approach, if you're trying to find the fair value of a piece of land or a building, most people will value that land or that building based on the value that they are going to derive out of it. So there are concepts like highest and best use. There are concepts, which say that if you are actually purchasing an asset, you are already aware of the kind of earnings that that asset can generate. You are even taking into consideration aspects like what is the tax break that you can get because of depreciation on that asset. So whenever you are valuing an asset and you're looking at it from the perspective of a transaction, at the underlying base, there is always a sense of what can this asset or this or this business generate in terms of future earnings. So that forms the bottom line, I think, for most valuations that we do. Occasionally, you will have assets which are, a defunct company, a company going into liquidation. At such times, you will focus only on the asset approach. For most going concern companies, we like to use a combination of the income approach and the market approach. We like to corroborate the evidence of one approach against the other approach. Am I going too fast, or does anybody want me to stop?
No, I think that should be all right.
All right, thank you, sir. I'm just moving ahead. So this is the discounted cash flow. So the core of any discounted cash flow is essentially the financial projections of that company or that business. So when you are looking at the financial projections, this is just a sort of a 6,000 feet view of what the DCF is all about. You start by understanding what are the current facts and circumstances of the company. How has it performed in the past? What has its historical performance been? This could be its financial data, which is of course very important, and also its operating data. So you will be actually looking at their MIS. It's not quite fair perhaps to ask them to create data for you, but most companies do have an MIS which they use for their own internal controls. And they also have specific metrics that they like to see. So, when they're evaluating their own internal performance. So the historical performance should definitely be considered from a financial as well as an operating perspective. Then you go into the projected performance, where you are trying to do a bridge between what they've done historically, what they're doing today, and what they want to do tomorrow and next year and the years after that. You will also be then validating all that information and their appetite for growth with other aspects like what is the market performance and what are other people performing, other people doing in the market as well. Once you have arrived at your free cash flows, which are based on the financial projections, you need to take a decision. Are you going to be valuing free cash flows to the firm, or are you going to be valuing free cash flows to equity? The big difference between these two methods is free cash flows to the firm are available to both the debt providers in the term of both interest and principal repayments, and to the equity shareholders, which could be in the form of dividends or could be in the form of capital growth, which is the growth of the value of their holdings in the company. When it comes to free cash flows to equity, you are looking at pure cash flows to equity, the kind of cash flows that you would have when you're preparing a standard cash flow statement, which is based on differences between the balance sheet items at any two periods of time. Last but not least, you come down to the valuation assumptions itself. You look at the cost of capital and you look at the terminal growth rate, which is getting into the mechanics of the DCF itself. The most important thing to remember, the reason why DCF is so popular and is used so extensively across the whole world is that most market participants do believe that cash is king. You might have the most beautiful asset in the world, you might have the most luxurious hotel in the world, but if it happens to be located in a place where it doesn't have occupancy, or it's located in a place where it is used extensively by, say, just the VIPs of that particular country's political class, who actually never paid for its services, that hotel is never going to be a valuable hotel. It will be valuable only when it starts, generating cash, which becomes available to its owners, which are the equity stakeholders of the company. So cash is king is pretty much a mantra which everybody practices across the world in real terms, and of course is followed by any valuation practitioner as well. I've already covered the fact that we need to do a deep dive into the business. The fun in a DCF, and this is actually the most enjoyable part of the entire valuation exercise, is really understanding the nature of the business. So, you need to sit with your client. You need to be very quickly able to grasp the kind of essence of the business. What are its key value drivers? Where is it heading? Where does it think it positions itself against the market? What are its critical success factors? What could be the potential pitfalls? One very important lesson that I learned, I think when I was a manager, in PwC, was actually an article which I had read online, which said, beware of discussions that you have with the promoter of the company. Very often what happens is that the promoter of the company is not only someone who's extremely energetic and is charismatic and is rapidly on his way to success, or has already become a very successful person, in a sense, a very attractive, energetic person. That person is also typically in love with his business. So when you are sitting with him and he's explaining his business, he's giving you his history, his thoughts and his feelings about how the company is going to grow further, just be aware that this is a person who has got two motives here. One of them is he wants to see a good valuation, so he's selling his business to you. On the other hand, he genuinely loves the business too. So he could very well start becoming blind to potential pitfalls or the fact that valuation can be constrained because of certain reasons. So great to have those discussions with the promoter. Much nicer than simply doing a desktop exercise by talking to the CFO. But just keep in mind that you need to always maintain an impartial and independent viewpoint. The advantage with getting into financial projections is that you do look at the interplay between the business, accounting, regulatory, and economic factors. An example of an economic factors, of course, the GDP growth rate, the nature of the industry, the trends that you're seeing in the industry, etc. Inflation. You need to consider macro factors. So start at 40,000 feet, come down to 20,000 feet, come down to 6,000 feet, and then get into the nitty-gritties of the company itself. So just always beware, garbage in is equal to garbage out. This is very true of anything to do with Excel modeling. It becomes extra true when you're doing a DCF. Put in numbers which are absurd and you will get an absurd result. And that's the reason why the DCF is something which should be done, if you want to get a really good understanding of the business, but it's always dangerous to use it on a standalone basis. You should look at the DCF when you're corroborating it against results which are obtained from the market multiple method, ideally. Just moving on. My system's a bit slow, just bear with me. Yeah. So let's just get into the financial model and what are the key aspects that one likes to consider. On the right-hand side, you see a sort of a downward arrow. And here we are considering what are the very high-level aspects, but critical aspects of any business plan and financial model. So you will look at revenues. You would break up revenues essentially into two components. One is the revenue breakup. You might have a company which is operating in more than one segment. You can have revenues which can be broken up into sales and other operating income. Good to understand as much information as possible in terms of revenues. Who are your key customers? Who are your key markets? What are your key products? What are the kind of trends that all these different line items have been demonstrating? So that's the second line item, the revenue trends. Then look at the gross margin trends. It could have been that the company is in a super stable environment, always maintains flat gross margins. It could be that here's a company which is now entering into maybe a late stage of its life and gross margins have begun to shrink. So it's good to understand how gross margins have been operating. Pay particular attention to the last 18 months. If you're doing a valuation, say as of 30th September of any month, otherwise try and go back for 2 years if you're doing valuation at the end of the year. But it's good to get this understanding. Then look at costs. Marginal returns are always important. So look at variable costs separately, look at fixed costs separately. Most financial statements today are not going to give you this information in a ready-to-eat format. So you will probably have to sit and figure out what you think are variable and fixed. Go back and discuss it with your company's accountants as well. Then see the EBITDA. Then, of course, work out the taxes. And if you're looking at deriving your future cash flows, you need to be looking at changes in working capital and you need to be looking at the annual capital expenditure. So like I was saying, there is a lot of confluence of accounting as well as economic, as well as business aspects when you are doing a valuation using the DCF method. Now, the left-hand side of the table is again a kind of high-level view on how does one really determine if the business plan is looking reasonable. So I think there are two important aspects which I always like to consider. One of them is if I'm just stepping back and taking a look at the business as a whole, and I look at it against the business plan as a whole. What kind of growth rates, what kind of margins, what is the kind of key success drivers of the business. On a mota level, is it looking reasonable or not? And if you start drilling down, it can be broken up into two large buckets. So the larger one, as you can see, is actually the historical data and the competition. So like I was saying, go back to the facts and circumstances and data of the business first as a starting point. So let's understand the historical data, understand who is their competition, who are the persons who are dominating the market today. Is your company a challenger? Is it a dominant player? Is it just really small and it's just about surviving and growing at like maybe 5%? If it is, why is it projecting 20% from next year? So get the background into your head. Start drilling down a little bit further. Does it have a brand of its own? Has it built up, even if it is a B2B presence? Is it a trusted name in the market? What are its target markets? Is it focusing only on India? Is it looking at South India, North India? Is it looking at urban versus rural? What kind of technology is it deploying? It will vary from company to company. So a pharma company will look very different from, say, a telecom one. But you need to figure out these essential components of the business. One very important source of information may or may not be available, will depend on the urgency of the valuation and its relative materiality. So if you're looking at, say, a listed company valuation, or you are looking at a purchase price allocation, which you're doing for a listed company, you will get access to specialized information such as board minutes and investor presentations. So just keep in mind in terms of the reason you're doing the valuation and the risk attached to it from both the company's perspective and your own. And don't hesitate to ask for information if you think you need it. Then consider any new initiatives, consider impacts of regulation. 2 years ago, I was valuing a leather company. A very critical factor that came out in terms of how the company would progress forward was the fact that the MEIS scheme was being phased out and nobody knew what the new ROTTEP scheme rates are going to be. We actually had to do modeling on 2-3 scenarios just to figure out what kind of a gross margin and EBITDA margin the company would have. And it was a borderline case for impairment testing. So one does need to consider regulations from different perspectives. Now we move to the financial projections, which is on the left-hand side. So how has the company done in the recent past? What has its budget been? What kind of variance analysis has it done for itself? How has variance analysis happened in the last 2-3 years? Has the company been very aggressive in setting budgets and never meeting its targets? If so, take a pinch of salt when you're looking at the financial projections provided by the management also. Look at the strategy, which gives you a long-term view. I'm doing a valuation right now for an international arm of one of India's largest business groups. They actually create a 3-year rolling strategic plan. So every time I do their valuations and I do an annual impairment testing exercise for them, they give me their 3-year SPP, and that's my starting point. Before I even look at what the projections, there's some 40 companies that have to be valued across the world. And what we need to do is start always with, in that particular vertical, what kind of a strategic plan are they setting for themselves in terms of growth or just in terms of even maintenance of profits? Other aspects to consider: if the company is showing a lot of growth in the next 5 years, does it have enough capacity? What is its capacity utilization today? How much is it planning to put in terms of capex? Where is it going in terms of capacity utilization by the end of the projection period? So is it going to reach some kind of a stable level by the end of the projection period? This is often something I see when I do audit reviews on behalf of an audit team of valuation reports that are coming to me. A lot of them are silent when it comes to capacity utilization. So there'll be very fancy growth numbers, but no correlation between growth and the enabling asset base that has to be created. Along with capacity utilization, investment plans, then of course taxes, and last but not least, what is the capital structure? Because this will then tie into how you are calculating the weighted average cost of capital. So I know the slide looks a bit crowded. At the end of the day, it's just important to know that you start with a high level view. You try and establish reasonableness and apply a common sense approach, and then start drilling into the details. So as long as you go in a systematic fashion, it's a very logical sequence of events that falls into place automatically.
It's an excellent slide, actually. Gives you all the information.
Thank you, sir. So just moving on, when it comes to financial model, the way I like to do it, and these are just talking points, really. This is not, part of any kind of a textbook or anything like that. Just very practically, if I were building a financial model for myself, what I would like to do is start with accounts, right? So plot the historical P&L account. At least 3 to 5 years, I think, is required for you to see any trends. Look at the year-to-date information, depending on the valuation date. Work out the basic ratio analysis. I can't tell you how important this is and how easy it is to review a file when this basic ratio analysis is in place. Just work out the year-on-year growth percentages. Work out a common size statement where you've taken your revenues as 100% and all items in the P&L account are then a percentage of the revenues. Work out what the effective interest rate is coming based on, because you plotted the balance sheet and the P&L account. You know your average debt balances. You know your interest cost. Work it out. Corroborate that information with what the management is telling you. So, you'll find that they've had interest rates of say 9, 9.5, 10%. But going forward, they're telling you that, that we think in our business plan is going to be 8%. So that is something which you will question and you will accept only if they've actually recently refinanced any of their debt. So it's good to have this basic analysis in place. Once the basic plotting is done, you're looking at your MIS and then you start getting into the business details. So identify those key segments. What are the product lines? Which are the geographies? Are there specific business verticals that they have created? One company that I was looking at in Mozambique, the name of the company actually fit into the distribution vertical of the parent entity, but 40% of its revenues actually came from distribution of automotive vehicles. 60% came because of engineering services that it was providing to Vale. The engineering services really had to do with components and the servicing of the mining equipment that Vale was using. But the very fact that 60% of its revenues was coming from engineering services division, just showed us so clearly that this is not an ordinary distribution business. It really has to be valued looking at it from a different lens. So I think identification of key segments should really be one of the starting points whenever we're trying to understand a business. Start understanding, study that segmental performance. I really like the BCG matrix. I know that it's considered to be old fashioned. I have the next slide actually talks about it. It started in the 1970s. It's very, very high level. But at the end of the day, when one is looking at trends and one is trying to sort of digest what a business is all about, these are just concepts like what is a star, what is a cow, what is a dog, or a question mark. You could either put your entire company into one of these buckets, or you could put specific segments into each of these buckets, and then get a much deeper sense of what the value drivers of the business really are. Then, of course, identify discontinued businesses, identify if new businesses have started, say, in the last 18 months, 6 months. When you're looking at the P&L account, this is the time when you will start, sort of separating information which pertains to operating businesses versus discontinued businesses, etc. I've already covered variance analysis. I like to do a basic cost analysis. So just take the SG&A schedule of the financial statements. Use a common sense approach. It doesn't have to be cast in stone, but identify variable, identify fixed, because that's the only way you'll get a fix on economies of scale going in future as the company is growing. Very important to identify non-operating and one-time expenses as well. That's how we arrive at the maintainable revenues, gross margins, and the EBITDA. And this is what you will now benchmark against the business plan that the company is giving you. All right. So moving on to the balance sheet. Again, very similar. Plot your information. Start identifying stuff that you will use when you are actually validating the financial projections. So identify operating items, identify non-operating items. You'll find, say, loans to a sister company or an ICD given because there was excess cash in the books. That's a surplus asset. That is not operating it. So loans and advances needs to be looked at. You will find bank balances, but you don't want to consider 100% of that cash as surplus, because you might find that a large part of the deposits are actually under lien when the company has taken loans. So one needs to understand the nature of certain items in the balance sheet a little bit carefully. When you're looking at, say, current liabilities, last year I was doing impairment testing for a leather business in Chennai. And I found that the current liabilities were only growing year after year. Company was beginning to exhibit signs of distress. And then I started asking, okay, tell me who your major vendors are. And I said, okay, now give me an aging analysis, because the more I got into details, the more it started to emerge that the company was getting solid support from a sister company within the same group, which was providing it with the basic cured leather, the tanned leather. And it was, it was never repaying the sister company. So that in reality is not an operating current liability. It's not something that you think is going to be paid off in the next 1 month or even the next 6 months. It's more in the nature of a debt-like item, which is support that has been provided by the sister company. So very important to identify this. The face of the balance sheet was showing negative working capital. The moment we cleaned up the current liabilities, the working capital looked far more normal and what one would expect from a typical leather business. So it's just very important sometimes to get into these details and identify what is truly operating and what is non-operating. So that, I think, is the key takeaway from the balance sheet side. Once you've identified your items and you've cleaned up your schedules, start working out, just like in the P&L account, you did a basic ratio analysis, do the same thing for the balance sheet. So work out debtors, sales outstanding, work out inventory holding period. What is your overall net working capital as a percentage of sales? How has this performed over the last few years? Figure that out and then compare it with what the company is showing in future. So the rest of it is capital structure, which you've already touched upon. What kind of leverage has it actually been, utilizing in the last so many years? Nowadays, particularly with new age companies, it's very important to understand, are there different equity instruments which are sitting on on the balance sheet? So is it just pure equity? Have they given preference shares? Have they given warrants? Have they given debentures? So try and get a little bit of understanding of those terms as well. Okay, so I'm just moving ahead. So this is the BCG matrix. Very quickly, just in case people want a quick recap. So basically, you try and plot your company looking at how the market itself is growing. So obviously, high market growth is where you see maximum potential, but also requires greater amount of investment. And where is your market share itself? Do you have a high market share or do you have a low market share? So the stars are where everybody wants to be, right? The market is growing and you have an extremely good presence also. So that's where you would actually want to park the bulk of your investment. So in your business plan, it's good to know that, does this make sense from an overall perspective? If this company is saying it is growing at so much rate and it is investing this kind of money, what kind of ROI, what kind of IRR do they have in mind? So stars is where you'd ideally want to be. Dogs is ideally where you don't want to be. So it's a redundant market. It's hardly growing. And you anyway have a really low market share. So you're not going to make money out of this segment at all. A question mark, a lot of Indian companies find themselves in this space, right? The way our economy is growing. See, there's high growth potential. The market is huge. You yourself might have a very low presence, or you might have started entering this particular segment only in 2019, and then you had COVID, and now you're sitting in 2022, and you have a small market share, but you sense potential to grow. So here the critical aspect is, are you willing to invest? If you are investing and you're expecting your market share to increase, is it making sense from an ROI perspective? So both as a business owner and as a valuer, sometimes I think, when one is evaluating a business plan, there's probably not much difference between the two, only to the extent of evaluation. Huh? When it comes to giving the valuation conclusion, that's when we become independent and we normally become very conservative also. And of course, the last aspect is the cash cow. So this is a mature market. You're not really expecting much growth. But without investing much, you'll maintain a high market share and your cash flows are going to be very good. So it's nice to maybe support a star kind of a segment with a cash cow kind of a segment as well. This is not something which I would actually say that I do formally every single project. It's not like I draw up a chart and say, this is my BCG matrix, but these are questions which I definitely ask myself. And these are questions which I would like to then consider, when I'm thinking about, is this business plan making sense or not? It's also an excellent way to engage your client and get into conversation, and then they start revealing more of their business, because you're setting accounts aside and finance aside, which can be a little intimidating to maybe a non-finance person, and you're getting into actual business information. I see that Sangeeta has raised her hand. Sangeeta, do you want to ask your question now, or should we wait for the end of the session?
If you permit, I can ask now.
Yeah, ask,
Sure.
Ask Sangeeta.
Okay. Ma'am, you have said market share should be pretty good. If it is good, then we can give good preference. So if we are talking about a small company in their field, in their so what would be the good market share? Whether it would be 2%, 5%, what would be the rate range in between the market share would be good? We consider good.
I think it all depends on what is the appetite of the company. Today, I was talking to a company this afternoon, actually, it's a fintech player, and they are a fintech player in the payment space, concentrating strongly on, tier 2, tier 3 towns and rural areas, as well as the larger urban ones, of course. And their whole focus is on financial inclusion and direct money transfers and APS and things like that. So considering the size of the market, they are quite happy to aim for they started 2 years ago, and they're happy to get a 5% share of the market, because today's market in India for payments is 50,000 crores every month, even in terms of gross transaction value. So even a 5% market share by, say, the end of the 3rd year or 4th year looks so aggressive. So it's difficult to pinpoint and say that there's no one size fits all, right?
Yeah.
Yeah,
so even 1 or 2% can be a good market share for a newly established company.
It could be. It could be. But what is more important, the takeaway that I get from the BCG matrix is, it is asking you, is it worth investing in this business or not? So are you investing in the business because you want to increase your market share? If you are, but there's a question mark because you're a very tiny player right now, you will probably test yourself and see how you're going in the right direction every quarter to see, or every 6 months to see that ROI, are you making sense or not? If you're a
Right.
star, then you probably invest with a great deal of confidence, compared to a question mark.
Yes.
Maybe the question mark is the one that is actually going to give you the best ROI as an investor, which is a different story. But it's a question of how you're gauging the amount of investment you're willing to put in and how are you going to measure the result of that investment. So a very
Right.
small player, the investment result for them is really the market share. A large player who's more established is going to worry more in terms of, their EBITDA and in terms of their cash flow. So all this does is really it's a common sense approach, and it's just telling you to think through before you take a call on whether this is a good business, a risky business, or a safe one. So, they're all labels that one, I think everybody in our heads, we can't see too many data points. We want to bring it down to a digestible kind of, data set. So that's where the BCG matrix helps.
Okay. Thank you.
Thank you. Okay, so this is the DCF model. Now we're just getting into the nitty-gritty.
Madhavi, before we go, would you like to answer one more question from Mukund Puranik?
Yes, of course.
Mukund, can you ask your question? Okay, I think let's move ahead. We will ask it later. Yeah.
Okay. So this is the DCF model. I've just taken sort of a standard template, which I use. The numbers are clearly place markers. I just started with 100 and grew it to 10% and 5%. But if you notice, when I was talking of the financial plan and the business model, there was so much of focus on the historical performance and on the current facts and circumstances. The DCF is the next step, because you have obtained comfort on the financial model. You are reasonably comfortable that the projected revenues and the EBITDA and the working capital and the capex are looking reasonable to you. So, the word is expected cash flows. So you're not looking at a pure projection. You're not looking at a wish list. You're looking at numbers that are probable and expected. So probable is, of course, for the nearest short term. Like in this example, say this was a 30th September 2021 model. So 6 months ending March 22 would have been the immediate short term for them. So there the numbers really have to be, sort of expected, because you know that you're going to achieve these numbers with a great deal of certainty. As you move forward, they'll start becoming more probable. But at the end of the day, there has to be a common sense in terms of whether the cash flows are looking reasonable, whether the growth is looking reasonable or otherwise. So if you see the first box, it's revenues and EBITDA. You're looking at a forward process only. Now you're not so worried about the historical period anymore because you've completed that job. And when you're looking at the projections, I like to look at the revenue and the EBITDA together, because this really gives me a bird's eye view of where the company is going. It's very easy now to start spotting anomalies. If you think that the EBITDA is looking too aggressive, or if you think that there are fluctuations in the EBITDA, then you know that maybe the financial model might have something off. Or if you think that now, revenues from 100, supposing I had 20% growth every year, then the rupee value of the revenue starts looking very large by FY26. Is that looking reasonable? It makes you just take quick bird's eye view before you proceed with the rest. The EBITDA actually is the starting point of the mathematics of the DCF valuation. So what I have presented here is a free cash flow to the firm model. The major aspect to consider here is that these are free cash flows available to service debt and then to service equity. So debt servicing includes interest and principal repayments, and hence interest cannot be modeled in the DCF. So you do EBITDA less depreciation, EBIT, and then calculate tax on EBIT. In the real world, one doesn't calculate tax on EBIT. One calculates tax on EBT, which is profit before tax. Here we do it on EBIT because we do not want to consider the tax benefit that the interest cost gives us. So then you arrive at the net operating profit after tax, or NOPAT. So up till now, it is still an accounting sort of a profit. Now you add back the depreciation, you reduce the capital expenditure, and you account for changes in the working capital. Maybe it is increasing, maybe it is decreasing. Normal situations where I would find a decrease in working capital could be if I've had unusually high working capital on my valuation date. For example, 30th September 2021. There are commodity-based businesses where the management's job includes tracking commodity prices and knowing when to source their raw material and when to keep low inventory volumes. So if you have been in a market where, say, PET prices have been dropping every month consistently, and you happen to be a plastic manufacturer, for example, then maybe you want to actually stock up on your PET stocks by 30th of September, because you know that Q3 and Q4 traditionally are quarters in which the sales prices start going up. Demand also starts increasing because now you're, a distillery bottle manufacturers or a juice, bottle, a juice company is now going to start increasing its own stocks. And so offtake increases, and hence you will require greater raw material consumption in the next 6 months of the year. So in such a situation, you might have had high working capital on 30th of September 2021, which will normalize by March 22. So you might in fact have a decrease in net working capital, which means there's been a release of cash. Otherwise, in a growing business, which traditionally has a positive net working capital, that is current assets are more than current liabilities, you would normally look for only an increase in working capital, which implies a cash outflow. So that's how you arrive at free cash flows to the firm. Now the mechanics of the DCF set in. So there is a valuation assumption, which is the discount rate. You apply the discount rate, and then you move to the right-hand side of the table, which is the terminal year. So any financial projection, it's very difficult to try and project beyond 3 years or 5 years. So, a new age business, say a startup business or a fintech business or an e-commerce marketplace, very unlikely that they'll really have a good visibility even beyond the next 18 months, or say a new AI company which is coming up. 18 months being too short to really take a view on everything, they will still try and give you at least a 3-year projection. A more stable kind of a business which has been around for a long time and the industry itself is pretty mature and is really looking in terms of how do I utilize my capacity to the fullest? What is my next round of expansion? I've got surplus land lying, in Aurangabad, and I decide to set up a second factory over there. Half of that cost is today sitting in my CWIP, but I know the second factory will become operational in 9 months from now. So how do I project that new capacity? And how do I project utilizing enough of that capacity? So then I will stretch my projection period for 5 years or even 6-7 years. So this is an important call that you need to take. But the value of the business is really not based on the cash flows it's going to generate in 3 years or 5 years or 8 years. The DCF is based on a basic presumption of going concern. So you're looking at indefinite life, at least 25 years, 30 years of life. So, it's you have to consider the value it is going to generate after the end of the projection period. And that's where the terminal year comes in. The terminal year is a construct which says that from year 5 or 7 or 9 onwards, the business has achieved fairly stable operations. It's now going to grow not so much because of volume, because its capacity has already been utilized, but it's going to grow with inflation and also considering the way the economy is going to grow. So that is your terminal growth rate. The EBITDA margins are now pretty stable because, when you're not growing rapidly in volumes, you're not going to get much more economies of scale. So better to consider a flat EBITDA based on what you have in the last year of the projection period. By this time, your capital base is also pretty stable. So all you're going to be doing is replacing, whatever is getting depreciated out with new fixed assets. And so you keep your depreciation flat and then you match the terminal year capital expenditure to the depreciation. So if you have a net block of 100 at the end of FY26, 100 remains 100 till eternity, till such time that the business is still operational. Mathematically speaking, if you don't do that, so you have depreciation of -3 and then you show capital expenditure of only 1, for example, then you run into trouble because, you will end up in a situation where your net block is going to go to 0 in a few years. So just keep that in mind. In fact, guys, I must apologize. I've actually, the signage is wrong. So I have add capital expenditure, depreciation, but it's coming negative, and less capex, which is coming positive in the terminal year. So please bear with me. This is a mistake over here. And what you really are trying to show is, a positive line for depreciation and a negative line for capital expenditure running throughout. So apologies for that. And then, of course, changes in net working capital. By the end of the projection period, you've established a flat working capital base. So if it is 25% or 26% of revenues, you'll assume that the same 25-26% is going to continue forever. So then it is growing only based on the growth in your revenues. So, revenue growth in the last year into 4%, which is your terminal growth rate, multiplied by 25% will give you your change in the net working capital. So these are thumb rules. The main thing to remember is that by FY26, you're assuming that your business has become very stable. You add up the value. Now coming to the bottom of the table, you got your total net present value of the horizon period free cash flows, which is from the 6 months ended March 22 to the full year ended FY26. You work out your terminal value, and that is essentially a capitalized cash flow. So it is maintainable cash flow divided by the difference between WACC and growth rate. That will be your exit valuation at the end of the projection period. You need to arrive at the net present value today. So the exit value or the terminal value multiplied by the last present value factor. In this current example, it's 0.6. Will give you the NPV of the terminal year. And that's how you arrive at the enterprise value. So like I mentioned before, enterprise value less debt works out to equity value. If one wants to refine it, it's actually less net debt. So you consider debt-like items, any adjustments for contingent liabilities, and then you add back the surplus cash or any other surplus assets. And that's how you arrive at the equity value. Okay, I'll break here because this is a heavy slide to digest. Does anyone have any specific questions on this?
I think, yeah, you need to go a little slow on this.
Okay.
And please explain it again after the free cash flow calculation.
After the free cash flow calculation. Okay. So you're okay up till free cash flows to firm?
Yes. Yes.
All right. So once the free cash flows to firm are, arrived at for the projection period, you can start looking at the discount rate to arrive at the net present value of those free cash flows as on the valuation date. In our case, the valuation date is 30th of September 2021. So 6 months ended March 22 are 6 months away. Then, of course, 18 months, and then you keep adding 12 months as you move ahead. There is a concept of a mid-year discounting. Essentially, what is happening is, supposing, say, you have free cash flows to the firm of 14 million rupees for FY23. These are not going to accrue to the business at the end of March 2023. They're actually going to accrue to the business for all the 12 months of FY23. So one doesn't want to value it only at the end of FY23. One takes a midpoint, which is 6 months. So 6 months becomes 3 months for the first period, ended 6 months, March 22. 6 months, you will consider 3 months for discounting. For the next year, you will consider the 6 months of March 22 plus 6 months of FY23. So that is how 6 plus 6 becomes 12. Then thereafter, it's a rolling 6 months. So it's just 12, 24, 36, 48. So it's just a concept of mid-year where you are saying, let's be fair to the company. This is not a dividend which is going to be declared at the end of every year. These are cash flows that are going to accrue pretty evenly during the entire projection period. So it's a convention that is followed. You can choose not to consider it if you think that your cash flows for your business are very different. Now coming to the discount rate.
So what is the working of the figure 3.7, 12.3 and all these figures?
The working for that is 3.9 for the first period, which is the free cash flows to firm for the 6 months ended March 22. Yeah, do you see 3.9?
No, I'm talking about the NPV 3.7. How is it calculated?
Yeah, I'm getting there. I'm getting there.
Okay, yeah.
So the free cash flows to firm of 3.9 get multiplied by 0.97, which is the present value factor, and arrive at 3.7.
Okay.
So this is the net present value factor is saying that a rupee in hand today will be worth less than a rupee 1 year from now. So a rupee today will be 97 paisa at the end of 6 months and will be 88 paisa at the end of 18 months. So you are discounting it because you're considering the time value of money, and you're also considering the kind of inflation, and you're considering the kind of opportunity cost that the investor is going to have. So we will
So
come to the
that is
discount rate
understood.
in the next slide.
That is
Yeah.
understood. The 6 and the 3, the number of months and discounting period factor are not forming part of the calculation of 3.7.
No, they form part of the calculation for 0.97. So when I am doing a net present value calculation, and I guess I should have written the formula here, the present value calculation is 1 divided by 1 plus the VAT to the power of the time period.
Yeah.
So here the power of the time period is 3 by 12, 3 months out of 12.
Yeah.
So it is 1 divided by 1 plus 13.5% to the power of 3 by 12.
That's right.
So that's how the calculation works.
Okay. Okay.
Now in the next year, it will be 1 divided by 1 plus 13.5% to the power of 12 by 12. So it's 1 year, because you're saying that you're discounting the period factor is working out to that.
Actually, you divide the earlier figure by 1.135.
Yeah.
Or 1. Yeah.
When you divide, no, if you are dividing 3.7 by 1.135,
no,
you are assuming.
I am talking about the figure of 0.97.
Yeah, okay. So 0.97, the formula is 1 divided by 1 plus 13.5%, close bracket, to the power of 3 by 12. You're discounting it by 3 months. And the reason why you are taking 3 months is because in a 6-month period, you're assuming that the cash flows are accruing evenly every month.
Yeah.
And then it carries forward from there, because you're essentially adding, half of each period that follows.
Correct. I think 2 people have raised hands.
Yeah,
you want to explain something to?
Yeah, I think it's better to explain it here, because this is a, it's a heavy slide to digest.
Yeah.
So we might as well discuss it when the slide is open.
Yeah. So whoever has raised hands, please ask your question.
Madam, I have one question, madam.
Yeah.
That is relating to discounting factor.
Yeah.
So cost of capital, madam, in case of listed entity, it is very easy. We can ascertain through CAPM. But in case of a non-listed entity, so there are several methods of arriving at cost of capital. So which according to you is the best? Can it be hurdle rate, or can it be bank rate and then build up with alpha? So which according to you is the best way of arriving at the discount rate? That is number one. And number two, the whatever we may call it, negative or not of a DCF. Here we are presuming that this capital structure will remain same. That is number one. And cost of capital will also remain same, which is not true, because these are dynamic. So do you factor in these in your valuation model?
I think you've asked very good questions and very relevant questions. So these are actually hot topics for discussion with valuers in general. So I'll try and answer it one by one. When I'm valuing a company, I'm valuing the company as if it belongs to a basket of investments, and the decision to invest in this particular company has been taken on the company's own merits. So if I'm doing an independent valuation of the company, I am not applying a hurdle rate. So a hurdle rate which a private equity fund or a venture capital fund might apply, saying that, for me, any cost of capital is 25%, because that's the IRR that I want to see. It doesn't apply when you're doing an independent valuation of the company. You have to be fair. This is a company in which 13.5% is a fair opportunity cost for anybody who is investing in this company. And by anybody in an FCFF model, it is a combination of equity and debt providers, correct? So equity is expensive, debt is cheap. So the WACC is somewhere in the middle. So I wouldn't use a hurdle rate for sure. A hurdle rate is something which an investor will do for their internal purposes. when they're deciding whether to invest in the business or not. But if you're trying to arrive at the fair value of the business, you need to look at the valuation of the business on its own merits. And what are the own merits? It's a risk and a return trade-off. So what is the opportunity cost if I'm not investing in, say, a leather company? Then where would I actually park that money? What is my next best use of the money? Correct? So I wouldn't use a hurdle rate. There have been enormous discussions, I think, and there's tons of literature that is there in the public domain on what kind of discount rate to use. But in convention and what is actually applied on a day-to-day basis is the CAPM model only, even for unlisted companies. The only difference is that you don't have a beta for the unlisted company. So you work out an average beta for comparable listed companies, and you apply that beta instead. And the next slide, actually, I'll show you how I work out the cost of capital. So I traditionally use the CAPM model whenever I do a valuation. The only exception is if I'm looking at valuing a startup, there are thumb rules that apply. So, you use ranges, discount ranges from say 25, 30, 35, even 40% for valuing a startup. Purely judgmental, very difficult to defend, but nobody challenges it also because everyone knows that the cash flows are risky. Right? So if you are doing a traditional business and you are arriving at a discount rate, the CAPM is the most acceptable method. It is also a method that is accepted by regulators. So the tax authorities will not ask you questions. It is a method which is accepted by auditors as well. So it's a very well established, internationally accepted kind of a method for arriving at cost of equity. And once you arrive at cost of equity, you consider debt and you arrive at the weighted average cost of capital. So that was my answer to the first question as to how I would arrive at the cost of capital. Now, the second question is a little trickier. You are talking about the fact that the risk profile and the leverage of the company will change from year to year. So how can I use a standard present value factor, correct?
Yes, madam. Yes. And another thing, madam, I fully agree with you with reference to your answer to first question. But I was surprised actually when I came across that survey, which was conducted by NSE and EY. And findings of that say more than 50 company or 50% company who responded to that survey, they are going by hurdle rate actually. So that because a developed country, I am also aware CAPM is the accepted model. And as you rightly said, tax authority also accept that. But that is not actually the findings of that particular survey, which is India specific. So there also it is specifically mentioned in developed country, they go by CAPM, but India more than 50% respondent have actually given feedback that they go by the hurdle rate. So that is how I asked that question.
I know, actually, India it is still very much an evolving field. And I've been doing valuations for 24, 25 years, and it is still evolving as far as I'm concerned. So two aspects here that we are also becoming, a little more technical, a little more worried about the finer aspects of valuation as we are gaining expertise in it. And I'm talking about the valuation community as a whole. And the other aspect is that the depth of the Indian stock markets is still not the same as the depth of what you would find, say, on an NASDAQ or one of the US or developed country stock markets. So today, if I'm looking for, comparable companies, I was talking earlier this afternoon to a company in Coimbatore, which has a very, very specialized product. They do bridge bearings, which are supplied only to construction and infrastructure companies, and they are used specifically in the construction of bridges. And now it is highly specialized even in terms of design, because every bridge has its own specifications depending on the topography and the design of the bridge. Now, how am I going to find a comparable company for this? Very difficult. So at some point, one will then say, let me look at the beta of the construction industry and then do some adjustment subjectively and arrive at a discount rate. So I'm not surprised if Indian respondents are saying that they use a hurdle rate. But the problem with the hurdle rate, it's your view versus the other person's view, right? How do you defend it? It's always easier to defend when you've actually looked at market data. And then if you decide, you adjust the market data. So, there's the concept called a company specific risk premium, which you can always do if you want to arrive at a slightly higher cost of capital, for example. But to just blindly put a discount hurdle rate of say, I always use 10% or I always use 15%, you can't convince the other person. It becomes a take it or a leave it game.
Very
So as a
right.
professional
correct,
valuer,
correct,
it's
correct.
probably, a riskier approach to take.
Fully
Yes,
agree. It is entity specific, not marketplace specific. So that is true.
Yeah, one must always take a market participant view. So now I'm coming to the second part why I believe that I don't want to use either a changing leverage or a changing risk profile in every year of my projection period. So I'll take it one by one because you've raised both points. I think both are important. When one is doing the cost of capital, let me go to the cost of capital slide. And other participants who have questions on DCF, just bear with me. I'll come back to the DCF slide and answer your questions. If you see how cost of capital is calculated, the first part is the capital asset pricing model or the CAPM, which arrives at the cost of equity, which you can see is 15.2% in this particular calculation. Then there is a cost of debt. And then there is a certain debt equity ratio. So when you are doing a weighted average cost of capital, it is cost of equity multiplied by 67% plus post-tax cost of debt multiplied by 33%. Is everyone with me so far?
Yeah, fully agree, madam.
Yeah. So now
Yes.
what is happening here is that this 3367, this is supposed to be the optimum capital structure for a long-term player and as a normal market participant. It is not company specific. You could have a company which has zero debt today, but it doesn't mean that you will give it a zero debt equity ratio if everybody else in the market has actually used their brains and actually taken debt because it's improved the IRR to their stakeholders. This happens to be a super conservative company. It's never taken debt. As a result, the returns to the equity shareholders are actually lower than they should have been. That's not a market participant view. So when you are arriving at debt equity structure, it is always advisable to take an optimum debt equity structure. It will vary from sector to sector. If you're looking at a software company, and particularly in the early days of the software industry in India, most software companies were not raising debt at all. Or you'd have startups, or you would have companies in new age businesses, for example, robotics or artificial intelligence, which even today in early stages don't raise debt because their market and their own cash flows are so uncertain that they don't want to take debt. That's a market participant view. So you will consider zero debt. If you're looking at an infrastructure company or you're looking at a real estate company or a pharma company, it's quite common in those industries to have debt because it improves the efficiency of your capital structure. So you will consider the average capital structure of the company. And that's the reason why you don't actually start looking at on a yearly basis, is your debt equity structure changing? Nitinji, you had raised your hand. Is it specific to this question?
Yes. See, I have two clients in this place called Nashik, where they have the dates. Actually, those are dates, but they keep it in the current liability, saying that these are short-term dates, and they keep renewing those dates. So they are not actually classified as dates for practical purposes of calculation of WACC. So in such case, what do we do?
See,
what do we advise a client?
Number one, you go back to this balance sheet. And I was saying that you need to clean up the balance sheet. So apart from identifying operating and non-operating line items, so you're very right. Now you're looking at current liabilities, and over there you've got a thing of, short-term borrowings repayable within the next 6 months, correct? Next 12 months. So that is really not a working capital item. It is not part of your current liabilities in an operating sense. It is actually part of your debt. So when you
for debt equity calculation, you should consider that as a
you should
debt.
Consider that, yes.
Okay.
But the second part is that irrespective of, these are all judgment calls that you need to take. Now you've ascertained the true debt of the company. So they had 100 sitting in long-term debt and they had 20 sitting in part of current liabilities. You've now made sure that the debt number is correct. It is 120, correct? But it could be that they have very low leverage. It could be that they are highly leveraged. What would you use as a debt equity structure in the WACC? That's the next question. So if they have very low leverage, you would ideally like to bring them up to an ordinary market participant level. If they have very high leverage, it gives you pause to think. And then maybe you will still use an average capital structure for the debt equity calculation, but your company specific risk premium, you will jack this up. Because in reality, the survival of that business will start getting into question if it's not able to service its debt. So you'll have to take some amount of qualitative calls.
Yes, true.
There are still some people who are entering right now. All right, do you want me to go back to the DCF sheet right now? I want to cover the next part, which is to do with the changes in the WACC on an annual basis. But I'll go there only if you are comfortable as far as the debt discussion goes.
So you have not used WACC as the discounting factor here.
I have.
Because it is 13% in your WACC slide and here it is 13.5.
No, those are just different examples.
Okay.
Purely different. So this is not really meant to be a live model. These are sample numbers.
Got it.
So the first principle which I like to use is that across all years of the company's life, it is going to be using an optimal capital structure, which is reflected in the calculation of my weighted average cost of capital. And hence, I will not change my discounting rate because of changes in debt. That's the first assumption. The second aspect which I'm now talking about is what about the risk profile? Won't the risk profile of the company change every year as it grows and it becomes more stable and becomes a stronger market participant? The way I look at it, and it's all very subjective. Everyone has different views, but the way I do it is that I'm valuing the company as on date to day. So if I'm trying to determine the net present value of its cash flows today, I will consider its current risk profile. So a very, very risky startup today might become a market dominant player in FY26, but I'm not going to give it a cost of capital for FY26 when I'm trying to determine its value today. So I will discount all its future cash flows at today's discount rate, which reflects today's risk and reward profile. So this is actually a very hotly debated topic. I think these discussions are going to go on for many, many years because nobody has been able to bring everybody to a consensus viewpoint. But to say that, a company today that has a present a WACC of 13.5% is going to go down to a WACC of 10% by FY26 is, I believe, very subjective, very difficult to defend to anybody. I would not do it. I'd rather be on the conservative side and use a standard debt equity ratio and a standard WACC across all the years. Are there any further questions? I'm sorry, I'm not opening up the chat because my screen is a little unstable today, but please ask your question.
No, thank you very much, ma'am. Thank you very much.
Thank you, Yogesh sir. Thank you. Shubham, I see that you've raised a hand. Would you like to ask your question?
Yes, hi ma'am. I just had a question around the last statement which you gave about the assumption of the debt equity ratio. Let's say if we have a minutes of meeting, or if there is a business decision where they are planning to include more debt into their capital structure going forward, like they have decided to include more debt in the next year or next to next year, then in that case, should we include that assumption? Should we modify our assumption according to it, or should we still go with the conservative approach of maintaining the 2:1 ratio as the debt equity ratio?
Number one, 2:1 is just a thumb rule, so don't go by that. The fundamental thing is that see what most companies in the market are doing. So what is the average or the predominant debt equity ratio that you have seen of comparable companies in the market? Okay. So try and take a market participant view. But when you are analyzing the company and you are forming your own view as a valuer as to how risky this company is, if they are planning to become highly leveraged from next year, then maybe your own viewpoint on the company will undergo some amount of change. You will start looking at them as a slightly riskier proposition. Everybody else is at say a debt equity ratio of 2:1, and these guys are going to 3:1. So you start wondering that what is the longevity of this business, and what will happen if a downturn in the business cycle hits them next year. So those are qualitative views that you will take.
Got it. Okay. Thank you, ma'am.
Welcome. There are another two participants who have raised their hands. Would you like to ask your question?
Hello.
Hello.
Yeah, ma'am, I'm audible.
Yes, Meet, you're audible.
Yeah, ma'am. So first question is, are we covering the sensitivity part of, arriving at the valuation? And the second part is, we also consider, transactions where we factor in 10 years for the valuation. So given just recollecting the earlier discussion that 5-year period is the best period we can forecast for. So generally in our case we value 10 years, 5 years plus 5 years of terminal period. Is it the right way, or in practice it is like you may consider 10 years as your forecasting period?
See, I think it all depends on visibility, because to me,
Yeah.
anybody who says that he is forecasting with any sense of confidence beyond the 5th, 6th year, either the business is highly predictable. There could be cases where you belong to a very cyclical industry. So, you want to capture one full business cycle and it's very well established, like oil and gas or, something like that. So you're able to see a complete pharma companies, in my experience, the businesses are fairly stable. Even if they are growing, they are predictable because they have pipelines of of their own products which are visible.
Yes.
There are regulations which ensure that they need licenses before they're allowed to operate in any territory. So they can't just tell you that tomorrow I'm entering the US and my market is going to explode.
Yes.
That's not going to happen unless they have US FDA approval. So there are ways in which you get a sense as to how predictable they are. So even there, traditionally they do 5 years. There are cases, as an exception, if you are valuing a limited life project, so you're valuing a road concession, for example, for 25 years. So now you know that the company is a special purpose vehicle, right? It's not going to exist beyond the end of the 25th year. Or most likely it will be wound up. And these are also unique cases where they will start with a very high debt equity ratio of 70-30 maybe, and they will go down to zero debt by the end of the 8th year. Just hypothetical examples I'm giving you. So in such cases, you would rather not do FCFF, but you'd rather do FCFE, so that you can actually factor the actual, debt repayments and the interest in your projection period. And then you will see that the returns to equity shareholders really zoom up from year 9 onwards. So only in those limited life projects, it makes sense to then not use FCFF, directly do free cash flows to equity and take the specific assumptions for debt servicing into your model itself. Sorry, I think I heard someone else talk.
No. Yeah, understood. Thank you.
Welcome. Does anyone else have a question? All right, I'm just going
I think
to move
more
on.
questions we'll take now at the end.
Okay, sure.
We'll take them
What's the
at,
time like?
See,
We only
8:15.
have half an hour left.
You have time till 8:15. After that,
Right.
we have 10 minutes for Q&A and then 5 minutes for closure.
Got it. So now just coming very quickly to cost of capital, I'm going to just touch on the CAPM, briefly for any participants who are not familiar with it. The formula for the CAPM says it is risk-free rate, and it's right at the bottom here if you want to read it as I'm speaking. It's a risk-free rate, which is traditionally one would use a long duration treasury bill from a sovereign government. In India, we don't have enough depth, and normally it's a 10-year G-Secs, which are at least better traded compared to the other T-bills. So we use 10 years. If you're doing a US WAC or Japan WAC or something, you will take a 20-30 year kind of a T-bill as your starting point. Then there is the concept of an equity market risk premium, which says that if you're not investing in the safest instrument of all and you're investing in equity, what is the additional return that you will need? Because higher risk is equal to higher return. So that's the equity market risk premium. And that gets multiplied by beta, which is supposed to stand for volatility of your stock. So higher beta, higher volatility. So obviously your cost of equity increases. Lower beta, far more stable, less risky, and hence your cost of equity goes down. So that's the formula. Risk-free rate plus EMRP into beta In India, because of the problems that we have in terms of getting a really nice comparable set, there is a convention of using a company specific risk premium. So, for example, here you can see that the beta in the plastic packaging segment is pretty low, 0.88. But then you're aware of headwinds that are coming up, in terms of petroleum prices, and margins might be shrinking. Company might be saying that, no, my margins are going to improve and they're going to go up by 4% by the end of the 6th year. Difficult to argue because it's the future, right? Is my view versus the management's view. So then I say that the cash flows are beginning to look a little risky to me. And so I add a company specific risk premium. This is really very judgmental. You can have arguments with anybody on this, with the management, with the auditors, or even the tax authorities. But just be aware that it is a convention. So then you do risk-free rate plus EMRP into beta plus a company specific risk premium. Up till last year, we were also adding a premium for valuation uncertainty because of COVID. Now we are seeing the requirement for that going down. And we've already covered how the weighted average cost of capital is calculated. So unless anyone has any questions on this, I'm going to move forward.
What is the source you use for the calculation of the company risk premium and the country risk premium, etc.?
All right. So for the risk-free rate, I like going to Financial Benchmarks India Private Limited because they actually give you the 10-year GSEC par yield. So, zero coupon yield that they calculate and they give it to you. So it's useful to use. That's a very safe source. The equity market risk premium, the convention that has been followed in India for many years is 7%. It's backed up by some research reports. So I know that PwC came out with one in about 2017-18, I think. Then other entities have also come out with a few reports. By and large, you will find the consensus is all roaming around 7%. So 7% is what even I use.
What about Ashwath Damodaran's data?
Ashwath Damodaran's data, I use it when I'm valuing international companies. When I'm valuing an Indian company, I have access to data. I can calculate my own risk-free rate. I can calculate, I know what my EMRP is. And then I use betas, for listed companies in India. So I'm consistent. I'm using all Indian data. If I'm valuing a company in South Africa, I don't have such knowledge of their markets. And I may not have access to expensive, databases like Bloomberg, for example, to get that information. So then Ashwath Damodaran becomes a safe source. So when you're following Ashwath Damodaran, you need to follow all the data that he gives. So start with the US risk-free rate, consider a country risk premium for the specific country your company, your business is based in. And then he also has information on beta. And it's backed with enormous research. So he's quite a safe source. He will give you beta for companies in the US, China, India, emerging markets. A good amount of information is available on his website. So I like using that for international companies.
Okay. And for a company which doesn't have any comparable listed company, can we use safely the beta as one?
Before taking that call, it's very, very subjective. Another way of looking at it, what are its user companies? So let's take the example of the bearings, which I use only for bridges. I know I'm very unlikely to find a listed comparable company which has a single product line of bearings which I use for bridges. But I can look at construction companies which are operating in the infrastructure space. So at least I look at the user beta, because beta is volatile. So suppose the user company has a certain volatility, it's directly going to impact its offtake from the company which I'm valuing. So it will give me a sense as to where I'm going. And then you have to take a practical view.
Okay. Because my client is a hospital. It's a limited company. So they have given me the names of some competitor hospitals, which are also again private limited companies. And we don't get any beta, etc. for a limited company.
But you do have other listed companies. So you got Care.
But near about should be comparable. No, this is a very small hospital company. So you cannot compare it with Apollo and all those big companies.
So what you can do is, the idea of beta is systematic risk, which is to say that most market participants in this space would have this kind of risk. So take the volatility of the listed hospitality companies and then do a company specific risk premium, because your
Right.
company is so small that it becomes
Right.
automatically more volatile.
Yes, yes.
So
That's
that
what
is
I
the
have
safer.
done for the
Yeah.
valuation. Yeah. I think then I am correct. Thank you very much.
I'm sure you were correct in doing it.
Yeah.
All right, just moving ahead. Okay, now very importantly, I don't want to get into the nitty gritties. As I'm talking, you guys can look at the specific examples. But remember, I was harking back at the beginning of the call saying that you need to think as an accountant, you need to think as a business person, you need to understand economics and etc., tax and all that, right? So any accountant likes the matching concept, and valuers also should love the matching concept. So this is all about logical consistency. Any valuation, if it has to be defendable, has to be logically consistent within itself. So if you are valuing free cash flows to the firm, you have to consider weighted average cost of capital, because the free cash flows to the firm are available to the debt providers and the equity providers. If you are valuing free cash flows to equity, consider only the cost of equity, which is always going to be higher than WACC. If you are looking at a subject which is sitting in Nigeria, you need to see cost of capital of a comparable company in Nigeria. You can't say holding company sitting in India and hence I'm going to use Indian cost of capital. That doesn't work. So you have to make sure that your cost of capital is corresponding to the territory in which that particular business is operating. Currency of cash flows. This is everything to do with inflation rates more than anything else. So if your projections are built in rupees, use an Indian rupee cost of capital. If your projections are factored in dollar terms, then the differential inflation between rupees and dollars has already been factored. So please use US dollar cost of capital. This is a very, very complex topic. I think as valuation practitioners, it makes sense to go back and read literature when it comes to cost of capital. Start with Damodar and move on to other practitioners. There is some excellent material that is out there in the public domain, but this is an extremely important concept. You need to be able to match your territory and your currency of cash flows separately, considering each factor with the kind of cost of capital that you are calculating. I know I'm going a little fast, but I just want to make the point that this particular topic requires reading and study. And as you move ahead and you start doing larger and more complex valuations, this is an area where you will be challenged by the other valuer. Beyond, projections beyond a point, neither side is going to fight much unless it is a dispute case. But if it is a case of company A having its own valuer, company B having its own valuer, the first tucker or the fight that is going to happen is going to be on cost of capital. So the more theoretical knowledge coupled with practical database information that you have, the stronger your argument is going to be in terms of defending your cost of capital. It's always a good topic to read about. Then again, match your DCF first year cash flows to the opening balance sheet. Very often when I have reviewed valuation work, I don't see that link. So my opening working capital, which I have calculated after separating out debt-like items and surplus assets from my current assets, current liabilities. So my operating working capital minus the projected working capital on 31st of March 2023 has to sit in my cash flows for the first year of the projection period. Okay, so it's very important that you actually sit and tick off the entire balance sheet. So you know how complicated Ind AS balance sheets have become. There are so many line items. Every line item has to be accounted for in the DCF. Either it is in the form of fixed assets, which are a continuing asset class. There's no cash flow impact of them except for capex, or it's sitting in working capital, in which case there is a direct impact on the cash flows. Am I making sense, or do you want me to go slower on this particular point?
I think that's fine.
Okay. Then when you're deriving your valuation multiples, what happens is, here's my DCF. I know what my enterprise value is. I know what my equity value is. Most of the multiples I use traditionally are EV by EBITDA, EV by revenue, for example. So my implied enterprise value, this would be as on 30th September 2021. So supposing it works out to 9 times of trailing 12-month EBITDA. I would like to cross-check this with what the market multiples are showing me. So it's the easiest way in which you're trying to corroborate the values between the DCF and the market multiples. Rather than looking at the rupee values, try and look at it from a derived valuation multiple perspective. So look at trailing 12-month EV EBITDA, look at 1 year forward EV EBITDA. Try and see what is your exit valuation in terms of EV EBITDA when you're doing your terminal value calculation. So again, just try and match what you're reading in the market with what your DCF Excel file is throwing up. So this is logical consistency that is going to run through your entire valuation exercise. All right, so then what are the critical valuation assumptions? When you're looking at the terminal growth rate, there is actually no formula, unfortunately, for deriving the terminal growth rate. One will go with the long-term inflation for the country. So in India today, long-term inflation views are traditionally 4 to 4.5%. So one would want to consider that. India might have a much higher growth rate today, but it's not expected to continue at 6-7% for the next 25 years. So one wants to take a long-term viewpoint. Traditionally, when one is looking at valuations, if one starts seeing terminal growth rates of say 6%, 8%, that's a very, very risky call to take, because you're saying that at least for the next 25 to 30 years, this particular company is going to grow at 8% every single year. At some point, it will turn out to be the market dominant player in its own particular industry. So it's a risky call. Try and restrict the terminal growth rates to something which is closer to long-term inflation and maybe slightly lower than the GDP. That is a far safer view to take. If you are valuing cash flows in US dollar terms, consider the US dollar inflation. Again, take a long-term view. US today is sitting at 4% inflation. Historically, it's always been at 2% inflation. Take a view as to what you would want your US dollar cash flows to grow at. The other valuation we've already covered, which is the discount rate that use either cost of equity or WACC, use the CAPM model. For terminal year, it is important that you use the currently prevailing marginal tax rates. So you do have companies that we will come across which have had historical losses. For the next 7 to, or at least 6 years, they might actually have protection because of, unabsorbed depreciation and business losses. But if your projection period is only ending after 5 years, it doesn't matter. For terminal year purposes, take the marginal tax rate. Because again, it is a long-term view that you are taking. So don't take a short-term benefit into your long-term terminal year calculation. Any questions on this slide, or should I move on? Okay, I'm just going to move.
Anyone has any questions, you can ask. I think we are good to go.
Okay, I'm just coming now to the last bit, and I think Smeeth had asked this question on the sensitivity analysis. When we are looking at the DCF, like I had mentioned at the beginning of the presentation, you have to be careful of garbage in, garbage out. So if your assumptions are not solid in the financial plan, it can go haywire. If your assumptions are not consistent when you're applying a discount rate and a terminal growth rate, your valuation conclusion can go haywire. So you do need to have reasonableness checks. The first reasonableness check is corroborated against the market multiple method. Corroborated against, supposing, say, a third-party investor has actually invested in your company in the last 1 year or 2 years. See what that valuation was. See whether you're still roughly in line, and try and analyze the reasons for the change in the valuation. Supposing this is a case of impairment testing, which you're doing every year, it's a very good idea to cross-check what your valuation was last year, and also, in fact, compare the assumptions in the financial plan with last year. See again what has changed. So reasonableness checks. Sensitivity analysis. It's always good to run 2 or 3 sensitivities. So you've already done an elaborate exercise of trying to identify what are the key value drivers for the company. It could be growing revenues. It could be an improvement in margins. The company has recently done a major cost restructuring exercise, and there's been a permanent improvement in the EBITDA margins by 3%. So that could be a huge value driver. But how do you know it is really permanent? How do you know next year competition is not going to come in and drop the margins to, by 2% again. So you run a sensitivity analysis. So this is all about the story that you've understood from the management and where you have identified potential pitfalls. So wherever you think there is a potential pitfall, run a sensitivity. Now, the traditional sensitivities you do when you're doing a financial reporting valuation is that you will test it for a drop in revenues. People will use a 10% drop or a 20% drop in revenues year on year. And they will also do a drop on the EBITDA margins. So EBITDA margins reducing by 1% or 2%. These are the traditional sensitivities. One can take a view based on your understanding of the market. So those are sensitivities that you will run on the financial plan of the company. Additional sensitivities, because valuation is so subjective, there's always a range. It's difficult for me to say that the WACC is exactly 13.5%. It could be 13%, it could be 14%, it could be 14.5%. Everybody will have a different view. So present a valuation with a range of WACC. Also a good idea to present a valuation on a range of terminal growth rate. You've taken 4%, maybe it'll grow only at 3, maybe it'll grow at 5. So it's good to show a range of terminal growth rate and a range of WACC, which can be quite easily done through a data table using Excel. So this is how you get comfort that your DCF number is making sense and how it would be defendable to a third-party challenge. I think that's it. This is just my phone number for anybody who wants it. Should we open it up for question and answers now?
Yes. Anybody has any questions you can ask?
I think Smeeth has another question. Yes, Smeeth?
Yeah, ma'am. So how do we factor actually transactions where we have deferred considerations or we have tranches in which considerations flow in the proposal value? So we subtracted from, what is the exact.
No, I didn't get the question. I'm sorry. Just start again.
So how do we factor? So there's proposal value and at the initial outlay we have, right? When we pay some certain company for the acquisition. So how do we factor, if you might, hello?
Yes, I'm listening.
So I'm saying if there is a deferred consideration or mechanism which is flowing, how do we factor in our valuation? Because today this is not an outlay for the company who is purchasing outrightly. This consideration for indefinitive years to come, and based on certain contingent events, how do we adjust it with the valuation?
Actually, you're talking about price of recent investment. What should be considered as that implied value? Because it is a structured.
Yeah, I'm saying if I need to pay 100 rupees for buying out a company, I'm valuing that company, that target, that 100 is not going to flow, within the same year. It may flow based on the events in the future. So how do
so that is actually, I understood the question. So when you have valued that company, now you're talking about, say, a transaction which is actually concluded. The buyer has said that, look, I want to buy a majority stake in your company, and I think that your company is worth 50. But as a seller, you say, no, my projections are awesome. I'm going to grow by 20% for the next 3 years. So I think my company is actually valued at 100. And now they are at a standstill. They're not able to meet at a certain valuation point. So they agree on a deferred consideration. And it's also contingent, because the buyer will say, I will pay you 50 rupees today, but I will only pay you the additional amount provided you hit those targets of revenues and margins every year, correct? So now what happened is, just like in your cash flows and your revenues, you had revenues coming in each year, you have a time period over which the consideration is going to be paid out. Yeah. So 100 rupees today is more valuable than 100 rupees, which is paid as 50, 25, and 25. Because there is a net present value implication of that 25. And supposing the 25 itself is also contingent on performance, then 25 reduces even further. There is a risk element attached to it, right? Yeah. So then there are actually option pricing models which you have to get into. Say that you have to do a fair valuation using those principles. Understood. And there's, because it also helps you in the payback period.
Because if that also changes once you
Yes.
change the
Yes,
section.
of course. But you can't take the gross value. The key message
Yeah.
is you can't take the gross value. You have to consider the fair value. And the fair value will be impacted by time value as well as the riskiness of that, the consideration actually getting paid in the first place.
Understood. Okay. Yeah.
Thank you. There are 3 more participants. Please feel free to ask questions in whichever order.
Hello, am I audible?
Yes, Shubham.
Yeah, Shubham, please go ahead.
So I have a question around the size of the size difference between the company which we are valuing and the comparable company from which we are taking the data. So let's say our company is very small size or at a very beginner stage, but the comparable companies are at a very high stage, or they are very vast in terms
Established.
of established one.
Yeah.
So how to factor in that size variance around it? And the comparables are also like there can be a scenario where comparables are into multiple segments where our company is into particular segment. So how to factors those things into calculating the betas and the other ratio?
Yeah, so these are all practical issues that we face on a daily basis. Let's go one by one. When it comes to size, there used to be a convention which I know a lot of valuers have followed at least till recently, where they take the transfer pricing filters of revenues. Supposing you are at 100, then you take companies which are up to 10% of your size. So starting with 10 and moving up to 10 times your size. So going up to 1,000, which I feel is too wide a range. But supposing you are a company which is only at 100 right now and you're really small, and there are no listed companies at 100 of revenue, but you do have smaller listed companies which are operating at 300 or 500 crores, right? So now obviously those companies are going to have a closer risk profile to yours compared to a 5,000 crore company.
Yes.
So you will take a practical view and say that I'm going to look at micro cap companies.
Okay, so we reduce the comparable company set itself, that these are the company which are best related to our one.
Yes, just be careful, particularly when you're looking at micro cap companies, because some of them are not frequently traded. So some of the filters that you need to apply when you're looking at the companies are look at the size, look at the comparability of the business, see how long they have been trading. Some of them might have just gone IPO like 3 months or 6 months ago. You don't have enough data. And also look at the frequency of trading. They look for at least the classic SEBI definition of a 10% of total float.
Okay, sure.
So anything less than that is better to avoid using those companies.
Got it. And do that affect the ratios as well? Like let's say if we are calculating an EV by EBITDA ratio for a big company, and then do we have to adjust that ratio to accommodate our company? And what are the adjustments we have to make? If you can put a light on that.
Yeah. So there also you will adopt a similar method. First of all, you will say, is this company really comparable to mine? So they will, India went through this phase in which a lot of software companies came up and then grew very fast. But we were valuing companies when they were still in the early stages, like maybe 5 years old, 6 years old. So for companies like those, we wouldn't use TCS as or Infosys as a benchmark at all. We would consider smaller companies which happen to continue to be in growth state but had listed, for example. So that's one. Now, supposing you take even say a mid-cap company because it satisfies the criteria of being in a similar business, exporting to similar markets as your target company, and also happens to be maybe 5 times larger than you. So you're 100 crore, that's a 500 crore company. Okay. But the fact is that that company has a longer track record. It's probably got established, profitability, which is why it went IPO in the first place, right? And why it is a listed company. It's got a certain stability and a certain brand name established, and it happens to be larger, which means that it is more stable and more likely to survive. So I would then, if I was using the EV EBITDA multiple of that company, I would apply a discount to mine. So 12 time EV EBITDA multiple, I'd bring it down to maybe 9 times, 8 times. I mean, that's very subjective. But,
but what are the logical factors behind bringing it down from 12 to 9 or 12 to 8? What will be the decision making aspects of those?
The first one is consider the size, consider the profitability. Beyond an extent, you don't have to factor it because you're starting with your own EBITDA. So if you're at a lower profit, anyway the value is going to be lower. But just take a long-term view that that company might have started at a lower profit, but its margins are steadily improving. Are your margins likely to steadily improve or not? So you can take a subjective view when it comes to earnings, but look at it as trends and not as percentage terms. You will want to consider aspects such as customer concentration. Small companies traditionally will, have maybe 50-60% of their revenues coming from a handful of customers. So the
Okay.
riskiness profile is more compared to a
Okay.
large company which might have 500 customers. So look at customer concentration. You might look at product concentration. Maybe there's just one single product that your company has. What will happen if it turns obsolete tomorrow, given the speed at which technology changes nowadays? So you need to look at it more. Again, you have to go back to the analysis that you did of the business and where you think the potential, critical success factors are and what are the potential pitfalls. Use those as your comparison metrics between the listed company and your own company.
Got it.
Yeah, I think we have time for only one question now. Neeraj, you can ask your question.
Yeah. So, ma'am, I came across one case where the software company having a few software. Hello, I'm audible. Hello.
Neeraj, we can't hear you.
Yeah, I can hear it. Neeraj, you can speak again.
Yeah, hello, I'm audible.
Yeah. Yes,
Yeah.
you're audible now.
Yes, ma'am, I came across with one software company who is having few products, software product. They are selling that product basically, and they are generating the revenue. Then they are asking for the value those software. So how to do that? Basically, can I use the DCF for that valuation?
When you're valuing a company which has a single software, the entire business is only that software.
Right.
So the DCF at a pinch, you can say, is more or less equal to the value of the software. Just reduce the value of the tangible assets, which is fixed assets and working capital. Take out something for goodwill, and that's the residual value of the software. It's more of a ballpark approach towards valuing it. The best way to value a software of this type would be to use an intangible asset method, which would be looking at relief from royalty or looking at the multi-period excess earnings method. But that goes into further complication. How large is this company?
I think valuation is around 51 CR.
51 CR, so it's pretty small, right?
Yeah.
All right. When you're valuing, I would suggest, number one, try and see what is the kind of replacement cost of building up that software today.
Okay.
Because it's risky. What can happen is this might in fact be a slightly older version of a software. They've developed a small and steady kind of a customer base, and hence they're generating revenues every year, right? But it doesn't mean that the software is using the latest code or the software is in line with the latest trends in the market, which means that they might rapidly start losing value down the line.
Okay.
So if they're asking you to value the IP, you'll have to just think about it from these terms. How risky is the IP itself in terms of its survival, in terms of its revenue generating capacity? And if possible, you do get sources like royalty source, or markables. You have to pay some $250 or whatever, but you can get a set of comparable companies which have royalty rates. So that is the safest way of doing it. But a 51 crore company is very small. Try giving it the cost approach. Okay. Run a basic DCF, remove the value of the tangible assets, which is the fixed assets and the working capital.
Okay.
And you will be left with the residual value, which is the value of all the intangibles, which is goodwill plus the software plus customer relationships.
Yeah.
So then try and see, use a subjective view that maybe 50% of total intangibles comes from the software. But it's a risky way to look at things. You'll have to cross-check yourself using 3 different methods, I would think.
Okay.
So don't take it as a low value engagement, because you won't recover your costs.
Can we consider with or without the method? Because if the software is not with the company, then the value is 0. And if the value in the software with the company, the value will come in something like 50 crores. Can we consider that method only?
Yeah, see, what happens is the company is the sum total of all its assets, tangible assets and intangible assets. And the software cannot be 100% of the intangible assets. It will definitely have goodwill. It will definitely have customer relationships. It will definitely have workforce. So you can only allocate a certain percentage of total intangibles to the software itself. So you'll have to take a subjective call. So do your DCF, which is the value of the business using the FCFF method. Out of that 50 crores, remove the fixed assets and remove the working capital. What is left is the value of the total intangibles. Then you'll have to use a subjective view as to what percentage of that intangibles is goodwill, how much of it is workforce, how much of it is customer relationships, and whatever is left is finally the software. So it's a little risky.
I think with the paucity of time we have.
Nitin, can I just ask one question? Sorry.
Kazi Saab, yes, please.
Yes.
Only one last question.
Madam, thank you very much. It is indeed a great pleasure to listen to you. Achha, my question is, this week there are two issues. One was Dharmaj crop, and then another one is some uni parts. Now, and then price band is fixed. Who are the people who fix this price band? Whether they are registered valuers or is it some merchant bankers? That is question number one.
It will be the merchant bank.
Achha, that is one. Secondly, in the YouTube, a lot of people come out and then they give their explanation. They make it for 10 minutes, 15 minutes. Very nice analysis. Are they registered valuer or they are just like freelancers and then they give opinion? Even they come on the TV channels also. Who are these people? Are they registered
valuation? Not necessarily, sir. Not necessarily at all. It could be anybody, right? Because even registered valuer in India is a new concept. So so many people have been doing valuation.
I don't think registered valuers can go public and appear on TV or YouTube.
In any case, probably there are restrictions in terms of what you can advertise and what you can't advertise.
For valuers, registered valuers.
Yeah. Thank you. And they do it so fast. Really, I wonder, because if once we have to do valuation, we will take at least 1 week to understand the whole gamut of issue. Whereas they do it so fast. I really wonder, and they come to fast judgment also.
No, I think, a lot of people take a very sort of short-term view that this is a small project, I'm getting paid a small amount of money, so I'll do a quick analysis. But there's a risk in that. I think you should not be too ready to part with your signature because your reputation is on the line and also your fiduciary responsibility that someone is going to take a view based on what you are saying, which will affect them financially. So it's always, I think valuations should be done with a great deal of care and responsibility. So sorry, I think there were still two more questions. Do we have?
I think there are a lot of questions, and if you permit, madam, I can ask the participants to connect with you personally because there are a lot of questions and we don't have that much time.
No worries. My email ID can be shared comfortably, and I'm very happy to even speak to people if you want to call me up and ask me questions. It's always a great topic to discuss.
So thank you very much for your kind consideration. Now I ask my colleague Asmita Phadke to propose vote of thanks.
Yes, thank you, sir. I really thankful and for such a Madhavi ma'am for such a informative and interactive session and wonderful presentation along with your step-by-step methodology on and the considerations. The way you explained that truly you are a role model for career seekers like us. And I thank everybody present here and all the participants for your valuable time. Thank you very much for such a wonderful session and informative and technical presentation. Yes, thank you very much.
Thank you very much.
So it was great, Madhavi, really great, Madhavi. I have witnessed a very good interactive presentation. So that's a great, and it has added a lot to our knowledge. And as you have already permitted us to ask any questions if we have in future personally to you. So thank you very much for that.
Most welcome. I've really enjoyed it, and I thank the audience for actually asking questions. And it's always good to be challenged and to be able to even give an answer which hopefully has made sense to the listener. So thank you very much.
You are a part of that group which we created for this today's webinar. So you can drop in your mail ID and your number on that. That will be helpful for the participants.
I will do that right after.
Because we will be dissolving that group within next 2-3 days time.
All right. I will give both my email ID and my phone number. And please feel free to reach out and discuss at any time.
Yeah. So Bhavesh sir, if you are there, can you give your concluding remarks? I think okay. So thank you very much.
Thank you.
Again,
Thank you,
again,
everyone.
all the
Good night.
participants, and thank you, Madhavi madam, for this very interesting discussion. Thanks. So we
Thank
can
you.
log off
Thank
now.
you. Thank you.
Yeah.
Thank you so much, ma'am. Thank you.
Thank you. Thank you. Good night, everyone.
Good night. Good night.
Bye-bye.
Bye.